All right. 1 second.
When Spencer the vegan
All right, give me a minute. I'm just gonna post that I'm live on Twitter quick. Cool. What up, Jason? What up, Zach? How's it going, Nicholas? I'm doing good. I'm gonna give it a couple minutes for people to get in here, then we'll get it started. Yo, thanks. Thanks, Zach. What up? Well, how's it going, Sassy?
Hey, Zach, my boy.
Trolling me on Twitter today.
Classic. I was trolling him last night in the Discord, so it's okay.
Yeah. All right. All right, we have. What's up, Gunny? Yeah, we are live, Lily. You got me a gift. I'm scared. Is there sound? Can you guys hear everyone?
Hello, everybody. How are you guys doing?
I think, yeah, it might be your headset, Nicholas. Or Gary. All right, sweet. We're gonna go ahead and get started now. So this is my friend Ben. If you guys don't know, he does have a Twitter in my description. I'll go ahead and post his link in the chat and I'll pin it if you guys want to check him out and some of his work. Other than that, he's going to do a little quick self-introduction. I'm going to go ahead and kind of be quiet and then we'll get started. So,
All right, guys. How you doing? My name is Ben TT. Thank you for having me on.
yeah, of course.
A little bit about me. I am 3 years into my trading journey now. Retail concepts in the beginning. Actually, a student of ICTs, ironically, which I didn't know back then. But ICT since about April. So going on 5 months now. Really been a eye-opening experience to see why the markets are booking the way they do and being able to read them with such precision. So for all of the people who are relatively newer in their journey, don't give up. The content there's a lot of it, but it is so worth getting through it and understanding it and being able to utilize it. So just keep going. Getting into today's lesson, market fractals, specifically looking at sponsorship timeframe, so where your analysis is coming from versus execution timeframe. So let's get into it. So I know this looks like a lot to digest off the drawing, but on the left side we have a standard market maker sell model fractal. For those of you who have seen Snipers live on TT's channel, this will be a review for you, but if you guys haven't, definitely go see that video. But getting into it, the market is fractal, so what you see on one time frame, if you drop down to a smaller time frame, you will see the same price occurrences within that model. And then if you jump up a time frame, you'll see you're inside of the same thing illustrated in this drawing. So here we have this first consolidation, first leg here, first distribution, second leg into SMR. Now, if you look up here, over here, this leg right here is right here, but it's fractal. So if this was like the hour, this could be the 5 minute, where you have 2 legs of rise, right? SMR, 1 leg of drop into a consolidation, right? That could be all right here. And then you have your second leg, 1 leg, 2 leg into SMR, and that takes you through your second leg. Does that make sense to everybody?
That makes sense to you guys. If not, he can kind of go over it. There was one question. Do you recommend checking out the monthly content for the mentorship or for ICT, or just focus on the 2022 mentorship?
I would highly recommend being consistent and accurate with the 2022 series first. Anything that you pull from the core content that is currently being uploaded is going to make things more complicated unnecessarily. Yes, you will be able to bring in some new aspects to your trading, but if you can't conceptually understand or execute the simpler concepts, the simpler model, it's just going to delay progress. There is a thing as too much information, which a lot of people say, core months 4, 5, 6 are really, a stimulating amount of information. So if the YouTube model is working for you, don't be too quick to jump into changing it, because if it's working for you, if it ain't broke, don't fix it.
Wait. And everyone said that it was making sense, so I think we're good to keep going.
So not going to do a whole lot of this. We're just going to hop right into some charts. Let me just remove all the drawings. All right. So here is a weekly chart of the S&P. And we'll go into full screen. Here's the weekly chart of the S&P. So just working off our YouTube model, what do we see in this current swing? We can identify right here, weekly FEG, right? Tagging into weekly FEG. Is this a tradable price action swing? Absolutely. If you are a position trader, you can easily sell this position right here. Valid based on the rules of the system, but where's your swing high? Your swing high is right here. So using a standard-ish risk to reward to get 2 or 3 to 1, where does your target have to be? This swing low that we just hit is 2 to 1. So you would need 300, 400, borderline 500 points just to get to 2 to 1, and then 3 to 1. This swing low, 3 to 1. That's a lot of time and a lot of movement just to get 3R. And put one more thing on the chart real quick. This weekly order block for reference later. So let's take what we've just gone over, the fractal, and zoom in on this occurrence in price. So we're just going to do the 4-hour. Right? Now inside the 4-hour, we saw we were in a weekly sell model on the weekly time frame. Now moving to the 4-hour, we can see on the way up to this weekly PD array inside of this weekly sell model, we recreate the sell model, or a buy model into a sell model, right? Now to get the same 2R, I'm going to delete this and zoom in on the SMR off your weekly zone right here. Okay, where is your shift in market structure? Right here. Right, where is your FEG? Right here. What is your dealing range? When did we take buy side and then sell side? Here we took buy side right here. All this is cleared out, and then we took sell side here. So here's your dealing range. Right? Where do we come back into? Let me actually change this one real quick. I'm going to change this. Sorry. I use a different color background for my non-sharing chart. But, here is your new dealing range, here to here, right? Where did we come back above equilibrium? Here. Is this tradable? Yes, right? Inside your FEG. Oh, all my stuff's got to be a different color for this background. Anyway, there's your FEG. So if we want to short this FEG, which is also valid, where's your swing high? Right here. This candle high is a swing high. And where's your 2R? You're already at 2R when you get to this sell side liquidity pool. Right? And that's 50 points, which is you've accomplished the same R gain in a literal fraction of the time. Now we can go, one step further into this. All right, let's go, say, the 1 hour. Sorry, let me exit full screen real quick. I'm gonna put bar replay on so I don't gotta keep shifting time frames.
Someone asked why the wick before is not a swing high, the massive wick.
On the 4 hour?
Let's see.
So why am I not using this swing high? You can use this swing high, and this would be the more conservative swing high to use, but this is still the previous. So this is the swing high where the move is originating from. So can I use this? Absolutely. Is this less likely to be rated? Absolutely. But this is still valid, because from here, this is where the move was created. This is where the shift is created. So for me, this is just a deviation from the range. Look at this candle, look at this candle, look at this candle's high. This wick is a deviation from the range. So they're grabbing liquidity up there. They're moving up there to grab liquidity, and they're coming back and returning into the range. I'm going to make this black because everything's blue right now.
Yeah, he said that makes sense.
Yeah, so that's just deviation from the range. And that's also another thing you could look at, right? Even if you want to use this as your range. I'm not going to get into that right now because it's going to make things a little more complicated, but we're just going to zoom in a little more. But it will come back up later. Right? So here on the hourly, right, is this a trade? Sure, absolutely. But as we know in hindsight, price is going to come back up into the zone and revisit. So this fractal right here, $15-minute. I can keep zooming into this, and there will be, I'm assuming, I don't remember offhand, that there will be an unmitigated fair value gap in here. We'll go to the 5. Unmitigated fair value gap in here. So inside of your already 4-hour fair value gap, you have a near miss, an unmitigated fair value gap. But in the process, you did take this liquidity pool. You took this liquidity pool. So what do we do from here? Here's your swing low, shift, take out this swing low right here, shift here, fair value gap, and done. And now, if we replay this, dragging slowly, and price just leaves. So by zooming in now from the 4-hour, you have this entry, which took a while if I keep playing, or, right here, I'll replay this short entry right here. This is your swing high, or this is your swing high, whichever one you want. Where's your 2-to-1? There's 2-to-1. Next liquidity pool, 4-to-1, right? So the power of being able to identify points of interest on a higher time frame and then recreate that model as you get deeper into price will not only allow you much higher R trades, and that's not always what we're chasing, but your time in the market is much shorter. As intraday traders or scalpers, this is ideal. We don't have to worry about long periods of consolidation, not caught up with price coming against us based on tomorrow's event. Don't have to hold through swap, nothing like that.
So, quick question. They had a few questions on mitigated versus unmitigated. Do you want to just go into a quick explanation?
Mitigation is just like a revisit. So when I say unmitigated, that means this fair value gap was left open. Similarly, like this gap that we tapped into up here to frame this entire idea, and I'll jump into the 4-hour. This gap that we tapped into right here, this is an unmitigated weekly gap. Weekly gap that was left open right here. So what do we know about fair value gaps? Fair value gaps are places where price wasn't offered efficiently. So price is going to seek rebalancing that before, leaving. So, downside targets, if I'm looking bearish from here, I'm looking to fill to this wick as like a first target on a weekly basis. Second target, weekly basis, this fair value gap because price wasn't offered efficiently here. Now, and that's really it. So unmitigate, if you're looking for framing ideas, you're looking for price where like liquidity pools or unmitigated areas.
Quick question is, what is sponsorship?
Sponsorship is just where the original idea comes from, right? So this idea is sponsored by the weekly. As we see, we have a weekly fair value gap that's getting mitigated or partially mitigated because we haven't filled the whole thing. So partially mitigated. So the weekly is sponsoring this move. Now, if the weekly is sponsoring this move, weekly sponsorship means weekly target. So like I said, that those two areas that we just discussed as possible weekly targets, that's where price is likely to go based on the sponsorship. Similarly, if I'm taking a 4-hour move, say this fair value gap didn't exist. We weren't sponsored by the weekly. And we just had, this model off a liquidity pool, and we had this shift. We are now sponsored by the 4-hour, right? So I can zoom into this model like we did, constantly zooming in. We did the 1 hour, we did the 15-minute, did the 5-minute, constantly zooming in and finding an execution time frame. You're looking for a low time frame model inside of a high time frame model, which will maximize your RR potential, as well as you can also increase your frequency inside of the model. So if I'm trading just the weekly, right, this is one trade to get back up to here. This is one trade since April, right? So assuming you didn't get this, which is also valid, assuming you didn't get this, since April, you've been waiting for a trade. Comes back, and now you're taking this, right? So longer term trading means, and ICT discusses this, position trading is there's very few opportunities, but those opportunities are massive, But by zooming in, we could increase our R to R, which, as a trader, we're trying to limit our losses to as small as can be and maximize our winners, let them run. And so like being able to zoom into price and identify where the move is coming from and find a low time frame like enterable mechanic, whatever your individual model is. We'll use 2022 as a baseline for this. You want to find your YouTube model inside of a YouTube model, and that's it. So the first model is the sponsorship. The second model is your execution.
Wait, one question. Do you consider a trade invalid when it comes back to your entry at a fair value gap? Do you kind of want to explain your invalidation point?
Fair value gaps can definitely be revisited, especially if they aren't completely filled in. The biggest thing for fair value gaps, because they are, and this is for your own study, but in my personal study, I've noticed them to be a little less sensitive than other PD arrays, depending the context. So for fair value gaps, I'm looking for candle closes to not disrespect the defending side of the extreme. So I'm looking for the top of this box. I'm looking for no candle closures above that, which we don't get. We see strong rejection here. We see instant rejection here. Candle closes below or even better, right?
Do you have any PDFs of your models for reference later?
I don't have one, but I can definitely make one and attach it to you. I personally use breakers a lot. So in this instance, I mean, I'm using the YouTube model as reference because it's the easiest to see, and that's what ICT is hand delivering to you himself. But he also does go over breakers. So something of interest to me here is this candle here. But I can definitely make a PDF and have that blasted out to you guys by the end of the night on the description of the video. And I'll also post it on Twitter for you guys.
I'll just retweet it as well so you guys can find it easier.
So yeah, and if you want to, getting back to breaker blocks, even though this is going to deviate a little bit, this is stacking confluence because as we see here, we have no candle closures above this breaker, as well as hard rejections from our OTFVG, right? And we know what happens after this, price just leaves. But you were able to get an M5 entry on a full, like as we zoomed in earlier, you were able to get an M5 entry on a 4-hour move. So I'm not going to tell you that I could have done this because I could not have held for this swing, but a 4-hour target is this low, this low, this imbalance, this low potentially, right? And it'll keep going because this is only the 4-hour. So you have this consolidation to take out, you have this consolidation to possibly take out. But by zooming in and getting a low time frame model entry, you're able to maximize your swing because even just the 1-hour entry or the 4-hour entry we have, you're using the 4-hour target. That's 5 to 1.
Yeah.
That's the 4-hour entry.
Do you think aiming 1 to 1R is reasonable for this YouTube model for someone who has trouble holding trades? I personally shoot for a higher just because 1 to 1 you have to win. That'd be 66% of your trades.
Here's the thing about R to R. The only thing that can answer that question accurately for you is you going through and playing with, if you're going to use a fixed R size to determine your take profit, the only thing you can do is go through X amount of trades, say, 20, 25, 50 trades using 1R, 1.5R, 2R, and see what the data tells you about your trading. For me, I like to be able to take profit at, 2R, 2.5R levels and let my trade run. I like 3R, 3.5R as a sweet spot, simply because the idea is I don't want to need to be accurate more than 50% of the time. Am I accurate more than 50% of the time? Some weeks I am. Some weeks if I take one trade and miss, I'm 0% accurate, right? So I'm not trying to, by limiting yourself to a 1-to-1, you're forcing yourself to be break even at 50% win rate. So if you have a sub 50% win rate, it's mathematically impossible to be profitable with a 1-to-1 R to R system. So you're going to have to go through data, log data, and this is where, the nitty gritty of trading comes in. Trading is like something or journaling is something that you keep hearing about, but even for me, I didn't journal for a very long time. And I promise, I know for myself, I delayed progress because I didn't have, things to reference, data to reference based on my trading performance. So even if you are all demo trading right now, which I highly encourage before you get into the market, take before and after screenshots of all your trades. Log them. What position? What instrument? What time? What direction? What were your entry mechanics, like sell side, buy side taken, market structure shift, fair value got created in either premium or discount, OTE, and be as dissect it, make it so systematic. Look for anomalies inside of your own trading, and that will prove extremely fruitful moving forward because it's going to build your confidence in your winners because you're going to be like, oh, I've seen this before. And you can literally reference it. Like, oh, I've seen this before. I've seen this 1,000 times. And that'll help you hold trades longer, as well as, not hesitate to get into a good quality setup.
Chase said, do order blocks or fair value gaps hold more weight? When should we anticipate to look for one? Or when should we anticipate which one to look for?
So personally, and this is why, like, everyone's, even though we're all learning the same thing, trading is an individual journey. So for me, I'm not a huge fan of order blocks, and that's just because I struggle to see them compared to other things. Like I said earlier, I really like breaker blocks, and that's just like something my brain sees better, right? Like it's just something that jumps off the page better. So you don't need to use breaker blocks, order blocks, fair value gaps. Like you don't need to use everything inside of, because he covers all this in the YouTube series. You don't need to use everything in ICT's arsenal. Identify what you see the easiest and then start studying what price does at those areas that you're expecting price to do X, Y, or Z. And again, that's just going to come through journaling. It's the nitty gritty part of trading, but it will prove so fruitful in the long run. But answering your question, you don't need to identify right away where price is going to go. Like you don't need to do that. Looking just at this fractal right here, and I'll delete everything besides the fair value gap and this, which is the breaker. Just looking at this model right here, right? You don't need to guess which PD array to pick, right? Because like this order block is small, so I really wouldn't use this. For me, it's not. It doesn't look clean enough for me, and that's just something you're gonna have to study. But what I do see very clearly that jumps off the page is this fair value gap, right? And then this breaker block, super clean, right before a stop run, right into a high time frame PD array that creates a shift, right? So I'm just watching what is price doing at this area. So we're just annotating this area as the breaker block, and we see no candle close above, no candle close above, no candle close above, on and on. One more run above these highs, clear out some early liquidity, and then dump. So you could take this fair value gap as your entry mechanic. You can take the breaker block as your entry mechanic, but it's a matter of what, like, do you see the best? Personally, I just don't do well with order blocks, and that's okay. Like some people love order blocks; it's like the only thing they use. Don't get married to a PD array because somebody else uses it. Find out what you notice best, and run with that. But getting back to your order block specific question, you're looking for a candle, the last candle, prior to an explosive move that also creates a fair value gap. So this for me really isn't clean. But what does stand out to me is this right here, this order block. And I'll put this in blue just because it's a different direction. But this order block, right, last down candle into an explosive up move. This order block rejected us twice. So, as a target, moving down here, filling your fair value gap, first target. Order block, second target. Sell side liquidity pool, third target. So it's like price is going to work from one extreme to the other. And in the process, it's going to go through the ladder of PD arrays. ICT refers to this as the PD array matrix. You've probably heard him call that a couple of times, but based on the direction, what PD arrays am I hitting first? So if price is here, this is a bullish order block. Price comes down through it. So what is below the order block? Sell side liquidity. Like that is the bottom of the bullish PDA matrix, right? And if we break that, now we've shifted. Now we're looking to go back up the PDA matrix, right? Breaker, FEG, bearish order block. If it was a little cleaner, I just don't like this one. And then buy side liquidity pool. So you don't need to marry a PD array. study what works for you, and when you notice it works the best, and use that. It's not a one size fits all. It's not a one thing is better than the other. It's just what you see the most and have data behind you to give you confidence in executing based off of it.
You want to explain real quick the difference between a breaker and mitigation block? Just
Breaker block creates a new high. So this is not a failure swing because we get above this swing high, right? This would be a mitigation block right here that's not revisited, or you could use this one, right? This doesn't recreate a new swing high. So this candle or this candle could be a mitigation block. Personally, I don't study a mitigation block, but a breaker block is simply a flipped order block. So when I say a flipped order block, if price is here, right now, this candle is a bullish order block, right? Now price rejects, and obviously we know what price does. Price has now broken this bullish order block. Now this candle, the same candle, is a bearish breaker block. So a mitigation block won't do that.
You only trade in the kill zones or the whole session?
I only trade the kill zones, and see, this is where you also have to find out what works for you best. I really like the PM session. I have a lot more data. The daily draw comes clear to me. If we've reached the daily draw, trading back inside the range, I notice I perform better, and things stand out to me more in the PM session. Now, that doesn't mean I'm not going to look at the AM session or attempt to trade at it, but like I will often miss a move in the AM session, um, either by requiring more data or not seeing the setup that I'm looking for, and that's totally okay. You don't need to catch every swing. You don't need to trade every session. People don't trade for days and weeks at a time. Like even right now, like I'm only averaging about 1 to 2 trades a week, even executing on a low time frame. And I found the most consistency and the highest win rate of my entire trading career doing so. So yeah, it's really where you see things the best, what you see the best, and journaling and data will provide that for you. If there's no other questions, I'll hop into another example.
Okay. I don't. Oh, how many pairs do you trade?
So I trade SPY and NAS, and then I trade. This is just I trade the majors AU, EU, GU. I look at UCAT a little bit, and then EG is just a reference. So I trade 4 currencies and 2 indices. The reason why I have this selected is I trade everything. I use the dollar as my barometer to everything. If the dollar doesn't agree with my position, I am not interested in it. Something I've taken prior to trading with ICT was the risk on, risk off aspect. So if the dollar is strong, I'm not looking for buys in majors. I'm not looking for buys in the indices. Anything standardized against the dollar, I'm not looking for buys against the strong dollar. So the dollar is the barometer to everything I do. If the dollar disagrees, I don't take it. I don't care if I miss the move. But intermarket analysis is a huge tool if you can learn when to apply it.
Quick, 2 more questions that I see right now. Do you only look for breaker blocks on higher time frames, or do you use lower time frames as well?
I use them on lower time frames as well. Like I said, there's like a ladder of things that are going to be respected, and if one doesn't hold, there's literally going to be one right above it. So above like this breaker block right here, there's going to be a fair value gap right here. And why did this breaker not hold? Because this price swing wasn't priced efficiently. There's a fair value gap, right? So price is likely to return back to that fair value gap prior to submitting to a lower PD array. And that's like something I also recommend for your study is notice when price leaves inefficient delivery and when it doesn't. What's a good example? Friday. We'll go to Friday on NAS. This was something I posted in Foresight, but the only thing that stood out to me, well, there is this liquidity pool here. Liquidity pool here, and there was a 4-hour order block here. So being the end of the week, I was assuming that price was going to accelerate towards its ultimate objective, either being, the midway point of this order block or this buy side liquidity pool. So what stood out to me below price, current price, was this fair value gap. And what did I do from here? I zoomed in, right? I'm going to put price replay on right here and zoom in even further. Now on the 5-minute, we see that price creates a higher high, right, digging into this order block come lunchtime. Oh, I'm sorry, I'm in the wrong space. This is not the open. I'm looking for the open, which is here. Rejecting the daily uh, 4-hour order block. What is price coming back into? Where's 9 o'clock? Am I stupid?
I think you're on the 1 hour, not the 4 hour, and you're messing yourself up.
I'm very lost right now. Here we go. Sorry, that's like the end of the day. That's what I'm looking for right there. I lost it again. Here we go. Okay. All right. So this being the first target, moving up because we're targeting the order block before we were targeting the buy side liquidity pool above us up there. We have sell side taken here, and then we have a strong impulsive move through a buy side liquidity pool. So I'm looking for a break in market structure to go lower to rebalance this hourly FVG. So let's move through price. We get that here, shift in market structure, right? So now I'm looking here. All right. Went a little bit too far. But can I take this trade? Yes, I can take this trade. Where would my stop be? Stop's the swing low. There. Because we can't use this one because we just rated this one. So, and there's inefficiency here. Inefficiency, inefficiency, inefficiency. So this is price can likely come up below this. We don't assume this candle is not here. Now, what would my first target be? First target isn't bad, 2.5 to 1. But you're looking at 130 points. We shrink, right? Now we're on the 1 minute. On the 1 minute, we see off of this zone, we've created a secondary shift in market structure after taking sell side liquidity. So this becomes our dealing range once we have a confirmed swing high in. So we'll go candle by candle. Now here, I'm likely to assume that price has confirmed this as our swing high. So this is my dealing range, right? What jumps out to you here? Price barely coming into equilibrium, leaving inefficient delivery below us. This is your trade entry. This is your stop loss. Now to get to the same 2.6 to 1 here. Now to get to the first target that's originally 2.6 to 1 is now 4 to 1. Let's keep moving through price. So now what do we see, right? This leg was delivered efficiently. There's really no gaps besides this one that gets filled in, right? Sell side delivery raid, energetic shift off our hourly sponsorship. Price comes back, hard rejection, starts leaving. Now, secondary shift in market structure. You're not going to see this on a higher time frame. Secondary shift in market structure. Fair value gap. Let's just move this fib over because this is your new dealing range. You have sell side taken here and buy side taken here. So this is your new dealing range. What we are looking for PD arrays below equilibrium for price possibly to redeliver. There you go, right there. 1 minute silver bullet. This trade, 2.5 to 1. This is halfway through the move already. And we're getting the same RR that we would have got if we took this, the lower entry. There you go. Out.
Couple
So
questions.
Go ahead.
Someone's wondering your ROI or ROR annually to determine the validity of this presentation. I don't know if you want to answer that or not, but
I am not going to go through my rate of return. I have posted a lot of equity curves on my timeline. You're more than welcome to go look at them. You don't need to value my word. Go through my Twitter. I call moves in foresight on my timeline all the time. Like this move we're going through, this was called in hindsight and delivered after the low on this swing was called in foresight, delivered perfectly, walked my whole timeline through it. So you can take my word and go and study it, or you can brush it off. That is completely up to you, and I understand your decision.
next one is, do you use SMT?
I definitely use SMT. That is why. So I will trade SPY, but I primarily execute on NAS. I use SPY because I'm looking for SMT in zones. Same thing with DXY in majors. If DXY is making higher highs and majors like AU, EU, GU are failing to make lower lows, that is something I'll be watching. So yes, I do use SMT, but it is not a leading it is not a leading indication for me. It is a secondary confluence for me.
Can you expand on the difference between market structure shift and a stop run?
That is going to come through. It is going to be hard for you first. So like this right here, breaking these lows, if you're too zoomed in or if you don't have context, like this will look like a bearish shift in market structure. Correct? Because, we took out this swing low with energy. We have displacement with a fair value gap. So it does fit the model. But you're not going to be able to differentiate a stop run versus against real direction until you learn how to figure your daily bias. Where's the likely draw on liquidity? Once you have that, the rest paints the picture for you. So like me, coming into Friday, I knew I was looking bullish because DXY for me was bearish. And that is something I posted last Sunday before the market even opened. I was risk on all week because interest rates in other currencies were rising. So because dollar will be weakening, that will give the opportunity to equities as well as crypto, anything standardizing against the dollar, the opportunity to push higher with less resistance. So I was looking bullish all week. With that in mind, I can differentiate stop runs versus price, like the real price swings. So I knew that this energetic shift down and this energetic shift down back into our POI was the first one being a stop run and rebalancing. Stops here equal lows, stops here into a unmitigated inefficient area. Price rebalances, finds your discount of this range, because this is the initial dealing range, right? Of this range, price finds discount and then moves. Shifts here, fair value gap, entry, first target. And as we know from Friday, price just continues to go higher.
Quick other question. Do you use intermediate term highs and lows, short-term highs and lows, and long-term highs and lows? And if you do, can you go through how you use it?
That will be like one of my next areas of study. I personally haven't labeled detailed like I know some people do. I just read price without it because I found enough consistency without it. Can you dive into it? And will I be diving into it? Yes. As I get through the core content, it will be something that I study. But if it's not something that I see clearly and I notice a difference in my trading performance using it, it is not something I'll be, constantly annotating.
And then do you use the 2-hour time frame or other unmentioned time frames, or what do you normally use for time frames?
So, I even though I primarily execute on the 1 minute, 2 minute, 5 minute, I do reference the 2 hour. I pretty much reference all the time frames because I really want to trade in line with the daily time frame, even the weekly time frame, right? Like I said, we are trying to minimize our losses and let our wins run. So if I can trade in line with the daily time frame using a much smaller time frame to find my entry, I'm maximizing my RR. Primarily, I always start my week. I always look at the weekly because I'm looking at my weekly draw. If I'm looking for my weekly draw, I'm looking at what are the PD arrays on the opposite side of my initial bias. So if I'm bullish and I have a bullish weekly target, what are my bearish targets for the beginning of the week that can take price up there? So I'm looking for PO3 or market maker buy model accumulation, sell side delivery into a PD array or liquidity pool into buy side delivery. I do that on all time frames. For every week, I use the weekly. Before every day, I'm doing that on the daily. And I'm looking for PD arrays on the 4 hour, the 1 hour for the daily, and the daily and the 4 hour for the weekly.
Jamal, I hope that also answered your question. Another question is your best way to backtest, in your opinion.
Pick an instrument that you want to study. Get your ICT kill zone indicator out, and whatever session you are, I know this is an international affair. So if you want to trade London session or New York session, depending on your asset class, it doesn't matter. Backtesting, you're just looking, map out PDH or PDH, PDL. So your session, your daily highs and lows. Map out your session highs and lows. Map out your weekly highs and lows, and just watch price deliver. You can use bar replay, or you don't have to. When I first started using ICT and I was backtesting, I was just scrolling through multiple time frames of charts and looking at session highs, daily highs, weekly highs, and what price did when we delivered there.
Any advice struggling for someone to determine daily bias?
It's really just you have to. It comes with time. It's definitely the harder one of the harder things to do, and you don't need to have your daily bias correct every day. You don't need to have your weekly bias correct every week. But what is price telling you on the daily time frame? Right. So I'll just take you through my process here. Right. And I'll use this because I know this one did it. So coming into this area, I was looking for where price could stop. And this weekly order block, I'll go to the weekly for you. This weekly order block stood out to me as the largest down close candle in this consolidation that created this large energetic up move. Right. So I'm looking at this fair value gap, this order block, and then if there's low time frame PD arrays inside this wick, or this sell side liquidity pool, or this sell side liquidity pool. But as we see, price got to this weekly order block and stopped. So we can zoom in. So if price is stopping here, what does this kind of look like from the beginning of the presentation? This kind of looks like that fractal model I showed you, where we have consolidation, full buy model, one leg, two leg, SMR, one leg of distribution, right? Second leg, consolidation, and now we could be using a buy model. So like based on this daily or weekly time frame, what could we be looking to fill? We could be looking to fill this fair value gap more or completely. You don't need to predict that. And that's like your first area. I'm looking inside of this gap. What is inside of this gap? We have this inefficiency that can be delivered to. We have this that can be redelivered to. This that can be redelivered to. This buy side liquidity pool that can be redelivered to. This fair value gap that can be redelivered to. So you don't need to answer. You don't need to know where price is going to end up definitively. Like ICT says, we are not in the business of calling highs and lows. We are looking for that piece in the middle that we can confidently say between where price is and where price is going. That is what we're looking for. So that's it.
Can you explain impulse price swings and market projection?
So I'm assuming that you are going to be in month one of the course or month one or month two of the core content. Impulse swings is quite literally just trend direction, right? Impulse swing is this swing. Protraction is when price is going to come back, or this is a better example because it's clean. Impulse swing is this. We take out this short-term low. Impulse swing is this. Protraction is simply price coming back up into an area of inefficiency, an area of liquidity inside of this impulse price swing. One of the biggest things that has helped me identify the real swing is, first off, premium discount and identifying dealing ranges accurately. So definitely study that aspect. If you can't find when to use premium discount, that will hinder your performance. And I know the inducement model has been brought up on this channel before, so I'm not going to go through the entire thing, but just on this price swing, like right here, right? Why was I bearish at this point? And this is something I also called publicly on Twitter with a position to take. Not that I take signals, but I was kind of, boasting my chest that I called the top temporarily. Why did I think we were going to have a reaction here? Because if we take our fib and we look at this price swing, well, right here, because this hasn't happened. Price for this impulse never came back to equilibrium. So for me, this is a stop hunt. Even though this is a large stop hunt, for me, this is a stop hunt because price was never balanced after this. Price will always oscillate from external to internal liquidity. This is what has helped me a lot, being able to identify this, and it does this on all time frames simultaneously, which can be hard to conceptualize. But even if you're trading on the 5-minute, you're still trading on the 15-minute, 30-minute, 1 hour, daily, weekly. You're still trading inside of that candle. So that will help you pick, especially in a trending market, pick which direction that you're going to be looking in. As we see here, price took external liquidity here, and here, price took external, sought internal right here. Now we have internal, we seek external here. Price came back, it didn't deliver to equilibrium. Sold off, took more external. Now price came back to internal liquidity. Relatively OTE, FEG. So not only did we come back to equilibrium, taking buy-side liquidity, we rebalanced inefficient price delivery, partially mitigating this weekly FEG, and then sold off.
Let's see. If you guys want to get your last few questions out, we have a few minutes left, but do you use the liquidity purge and revert concept of ICT's 2017 video, marking high and low the last 3 days?
Personally, no. And for me, purge and revert is something I look for purely at like the end of a daily or weekly time frame. Simply because power of 3 or open high low close, open low high close. Despite the outlying closes where we have a candle like this where it closes at the high, typically on a given price leg, we're going to distribute said price leg. So for me, if we reach our weekly objective on a Friday or a Thursday, if we purge Thursday's high and see a shift off of Thursday high, for me, that's purge and revert. I don't use his look back theory. I really haven't studied it too much. Like I said, I found what I like to have niched down into. So for me, incorporating more things, isn't always going to result in a net positive transaction to my system.
And then last couple questions. Do you use the fib in determining price targets or TP?
So you're talking about like standard deviations? Not always. I really use the PD array matrix, mostly liquidity pools as targets, depending if I'm trading with the trade or counter trend trade. If I'm trading counter trend, I'm looking at PD arrays. So like this sell side swing, if I sold this on my MT4 broker instead of options, I'd be looking at this for value gap and this with the order block and then the sell side delivery pool. Simply because for me this is a temporary shift in market structure, so I'm not 100% certain that we are reaching for these lows yet until price shows me that that's what it wants to do.
And then, are you bullish on the indices?
Temporarily, yes, and that is so. Like I was talking to you guys earlier, I do everything based on the dollar, and I called dollar weakness based on the fact that interest rates were rising in other currencies. For those of you who don't know, this number that we get over here is a derivative of what our dollar is standardized against, and that is a pool of other currencies such as like the euro, pound, the yen, stuff like that, the Swissy. So based on those other currencies, all declining because of a stagnant interest rate by their Fed not tightening their policy or having the inability to tighten their policy based on their economic conditions, the dollar kept going up and up and up and up and up because we kept raising our interest rate. That is why you saw this parabolic rally, because the dollar was the only currency that has been increasing its interest rate forever, however long, probably the entire year. But recently, we just had this past week where Euro did it. Okay, markets open. Good luck, everybody. Euro did it. I don't remember if Australian dollar did it, but other currencies raised their rates. So likewise, the disparity between interest rates is now smaller or decreasing. So those currencies are going to pose strength. If those currencies are posing strength, that means just based on our currencies being standardized against theirs to determine our strength, that means ours should come down. Not only that, we did hop into like a daily, weekly, monthly liquidity pool and PDRA up here. So just a reaction off there should take us back into inefficient areas like this sell side pool or this FVG.
And then a couple more questions. Why does liquidity, aka limit orders, matter so much when the market has to trade millions, lots of market orders to get to those liquidity spots?
So I still phrase this as in, well, first off, the market is booking liquidity on all timeframes simultaneously. It is engineering liquidity and then taking liquidity on all timeframes simultaneously. But the real targets, and this is words of ICT, says they come from the daily and higher, because that's where the big money, so institutions, banks, large funds, they're operating on daily and higher. So that's why he uses the daily as his, where he picks his targets for the day. And then, like I said, like this whole lesson, zooms in on price to find how price can possibly deliver to his daily or weekly target.
Someone asked, do you use the COT data?
Commitment of traders data, no, I do not. I really use the dollar to confirm if I have analysis on SPY, NAS, any major. If the dollar analysis fits my analysis on a related market, I take it. If the dollar disagrees, I just wait.
And then someone said, if price is not coming to the 0.5 of the fib and it does stop run, it becomes internal range liquidity. Sorry, I can barely read that.
Yeah, so when price comes down to the 50 and then leaves, something to monitor, and this is not a definite, because you never truly know where price wants to stop. You never truly know where price is going to reverse. So don't come into this space with an expectation that this means this, because there's always something that you could have missed, or that price is being heavily manipulated at that time where it doesn't work. There's always the uncertainty in this business. But look for price swings. If that 50 has the only unmitigated area in that price swing that you determine your dealing range, then that's a strong indication that price will continue to go higher from there. But if we leave unmitigated fair value gaps in, like OTE, you can still take that equilibrium entry. But there is going to be a level of possibility that rises to come back and fill those inefficient deliveries of price prior to expanding more.
Then someone was wondering your win rate, I guess.
I haven't lost a day in the past 3 weeks, but trading is not a consistent thing. Prior to that, there was like 2 weeks where I was losing, but balancing drawdown is like part of the job. My win rate is teetering somewhere in like the mid 60s, but like again, that fluctuates week to week, right?
And it also depends on what risk to reward you're targeting. So to keep that in mind with
Yeah,
win rate, guys.
Don't mix up win rate with strike rate, because my win rate is just when the trade isn't a loss. Break evens aren't accounted for in that, so I'm relatively aggressive with my stop after because I also scale into positions. So if I'm scaling into a position, my first position is coming to break even, or I'm trailing my stop to where my second stop is, which is typically going to be above where my first entry was. So break evens aren't reflected in that. So even though if I could say 60% of my trades aren't losers, which is what win rate is, that doesn't mean I'm hitting my take profit 60% of the time.
And then the last couple questions we'll let before we let Ben go is, what entry patterns do you always look for, or what is your single favorite one? And then what's your favorite time frame for breakers?
I like high time frame breakers that price submits to over a consolidation period. I like that because it allows a consolidation on a breaker allows a internal liquidity run to be had, so you can zoom into that price leg even further. PD arrays that I like a lot, I like balanced price ranges, which are FEGs that have already been filled that get revisited. Something for your journal, so that would be like this. If price wants to come back down to this fair value gap that's already been filled in, this should be a sensitive area in price. If price wants to continue going higher, right, it could run out these stops and fill this inefficiency. But I like, so a balanced price range is just like a FEG if it was a breaker. It's a breaker FEG. But I like BPRs because they tend to be more sensitive than fair value gaps, and I like breakers.
And then the last two questions we'll answer are, what instruments do you trade? Which I know you already answered earlier, but if you just want to re-clarify. And then do you plan your trades with high and impact news?
Yeah, I trade dollar derivative markets. So I use SPY NAS in the equities, and I trade AU, Australian dollar, US dollar, EU, Euro, American dollar, and then pound dollar as my main three. I sometimes trade UCAD if it's like really nice. That pair is a little bit funky. But that's it. Everything has to be dollar confirmed for me.
But all right, so that will be it all. Thank you guys all for coming out, and thanks again, Ben, for giving us your time. If you guys haven't already, make sure to check out Ben's Twitter. He might be coming out with a YouTube channel soon. If we'll see. And thank you guys for all coming.